It is time for the word on Wall Street. Top investors watching your money in a nervous market. Joining me right now is Stifel Chief Economist Lindsay Piegza, Rosecliff Capital CEO and Managing Partner Mike Murphy, and Mahoney Asset Management CEO Ken Mahoney. Great to see everybody this Friday morning. Thank you so much for being here. Lindsay, kicking things off with you with a new Reuters poll showing economists are predicting that the Federal Reserve will raise interest rates 3 times this year. Here's a few of my guests this week and how they see things playing out. Watch.
I think the Fed's going to raise rates 5 to 6 times. I think they're going to start to work down their balance sheet this year. And I think you're going to have 10-year treasuries get close to 3% when all said and done in 2022.
Right, where for the first time in my life, there's huge pressure and wages and people.
But the market is going to react strongly at some point, and I don't think the Fed will, once that happens, continue to push forward. I think they'll take a pause. There's too much money forced out there. Stock prices did exactly what the Fed wanted them to, but now that's going to start to run into reverse.
The Fed has really done a job here on the average investor because they've been selling us hard that inflation was transitory. So what happened was you had an incredible buildup, as you just said, in growth stocks and deflation plays. Now the Fed's coming clean, admitting that inflation is much more sustainable on a higher trajectory. And so they're out there trying to claim that they're going to do 4 hikes this year and maybe even more next year.
Lindsay Piegza, your reaction on how all of this is playing out. Before the last few weeks, investors were underestimating the significance of this major move with the Fed going from easing to tightening, no?
Well, absolutely. The Fed has taken a decisively more hawkish tone towards policy, suggesting that they are poised to raise rates 2 or 3 times this year, maybe more. But it's going to very much depend on the underlying growth rate and the trajectory of inflation. Now, the Fed did revise higher their expectations for inflation this year, but policy officials have been very clear that they do expect headline inflation to abate in the second half of the year and more aggressively in 2022. So if, in fact, we do see near-term relief in the form of a second derivative decline, meaning a slower pace of positive price increases, this is going to remove some of that sense of immediacy for the Fed to act aggressively. Again, we do expect the Fed to raise rates, but this call for aggressive action is going to very much depend on inflation. The Fed wants to control inflation. The Fed wants to rein in inflation expectations, but they also recognize that the economy is still very fragile at this point, and the market is very much dependent on the monetary policy punch bowl. So they don't want to be overly aggressive and pull the rug out from under this recovery.
Well, you know, Lindsay, I spoke with one major CEO yesterday, and he said to me, Maria, do not expect this chip shortage to go away anytime soon. He said things got worse in the 3rd and 4th quarter last year. So I ask you, what are you expecting in terms of these issues, whether it be the chip shortage or the tight labor force or the inflation spiking? Do you think the Fed will be successful in actually taming these issues down?
Well, that's a big question. When we look at the supply chain issues, there actually is an expectation that these could intensify, particularly as we see many developed countries going back into lockdown, imposing very stringent safety measures, including China's zero COVID policy. But the Fed raising rates doesn't address cost price pressures on the supply side. In fact, it will do the opposite. Raising interest rates would actually raise the cost of investment, raising the cost of business, forcing consumers then to deal not only with lingering elevated prices, but then contend with the issues of a slowing economy. So the Fed has to face this very delicate balancing act, knowing that monetary policy is not going to impact the supply side. Now, yes, raising interest rates will impact the demand side of the equation, but it remains a question how much of the recent inflation is driven by demand versus driven by these temporary supply disruptions, which monetary policy will have very little to no impact on.
Yeah, it's great analysis, Lindsay, as always, from you. Mike, what are investors doing? They're selling now and asking questions later. Look what's happened to growth, Mike. You've got the NASDAQ down 5% this week. Crypto takes a hit. $147 billion wiped off the crypto market just in the last 24 hours. Bitcoin prices dropping 8%, Ethereum down below $3,000 as cryptocurrency hedge funds marked the worst performers last month with an 11% hit last month. Mike, is this the right move? Sell growth, sell risk assets as we question whether or not the Fed is going to get this right?
Good morning, Maria. I think selling right now is, as you say, it's hit all growth assets. So it's just risk off, sell the high growth names, including Bitcoin. But I'd like for people to separate the two of them, because when you talk about growth equities, for me, it's easy to price these. It's easy to look at current earnings. It's easy to look at future earnings and see where, if there's a pullback in a company like Apple or a Netflix, where you would be comfortable stepping in. I think when you look at Bitcoin, though, or any of the cryptocurrencies, it's very different because, in the last few years, Maria, remember, Bitcoin had a drawdown of over 80%, and then it had a drawdown of over 70%. And so now we're down almost 50% in Bitcoin. And my concern is that a lot of people who felt like they had to get in when it was going from 40,000 to 50,000 to 60,000 are now sitting here in the 38,000 range, and they're going to end up selling and taking a big loss. I don't know where the buy point is on Bitcoin. So I think for people who don't have a longer term time horizon, they should focus on investing in the growth equity side of the world, not in the cryptocurrency side of the world.
Yeah, but then let's look at the fundamentals then. I mean, Netflix is down this morning. Ken, your thoughts on this lower subscriber growth last quarter for Netflix? You also have Peloton back up 5%, but it had a tough day. It was down 24% yesterday. The company facing reports that it will halt bike and treadmill production in some areas due to a significant drop in demand. Your thoughts on these two, Netflix and Peloton, the two story stocks of the morning?
Yeah, now first Netflix, I mean, let's look. They operate in a very narrow moat. There's so much competition, Hulu, AT&T, on and on. So, there's not big margins there to begin with. And I'm afraid Netflix shareholders are going to get in this analyst downgrade cycle, where they go from buy to hold or hold to sell, or from $400 a share targets down to $350, $300. And these same shareholders of Netflix are going to be like a quicksand, trying to get out of this thing and missing the opportunity costs and other leaders. Now, as far as Peloton, we never saw that as disruptive technology. I mean, putting an iPad on a treadmill to me is not so disruptive. It's very 2020, which, we're all living in caves. In fact, most people, when they work out, they want to work out in groups and they want to socialize. So we also saw, again, a huge amount of inventory out there on Craigslist and, kind of undercutting the company. My story about Peloton, though, Maria, is very concerning because who knew what when? How is it that all these insiders sold tens of millions of dollars of stock at Peloton? How is it like days before them cutting off on manufacturing, a whole bunch of puts were bought? I know the SEC loves going around putting out, these parking tickets, but to make us feel more secure, I think they need to understand more what happened at Peloton. So that's my major issue with Peloton this morning is who knew what when, Maria?
Yeah, it's a good question. Real quick, Ken, do you want to buy this dip, or do you want to get out of the way as the sell-off intensifies this year?
So we want to protect our capital. This happens. I do hopefully in a couple of weeks, Maria, though, we'll get some tech leaders that instead of going downhill, that will talk about raising estimates and raising guidance, and we want to jump on those names. Okay. So I think we're going to separate the men from the boys very soon. Soon we're going to get some help on the way, I believe, and some companies are going to guide higher, and that's when you're going to start focusing your money on.
All right, we will leave it there. Lindsay Piegza, Mike Murphy, Ken Mahoney, always a pleasure to see you all. We so appreciate your time this morning. Have a good weekend, guys.